Hi believers, this is Amit from the Wire team and I am here to provide our weekly bite and the road ahead in the markets. It was a consolidation week for Indian equities with Nifty losing around 0.9% and Bank Nifty closing flat. In broader markets, a mid-cap index ended flat and small-cap ended in red, losing 1.7%. The negative closing was mainly due to mixed investor sentiment amidst ongoing EFII selling and limited DI buying. Also, weak global cues, especially from sovereign technology and AI stocks, in US markets also contributed to subdued trading activity. Additionally, profit booking pressure persisted, particularly in sectors like financials and real estate that got impacted due to FIIs taking money out. Broader market breadth is weak with only a handful of stocks showing any follow through moves driven largely by earnings surprises. Although the overall earnings trajectory for Q2 of Y26 looks marginally better than the last 4 quarters, the broader market is at standstill. Among the sectoral themes, PSU banks stand out and are one of the only few sectors that are in structural upwards momentum. Other strong sectors include auto OE, MES and ancillaries, capital market companies select CDMOs for engineered buildings and metals. Technically, the Nifty managed to hold its trend line support on the daily chart after retracing nearly half of the previous rally. Stability above the 25,600 level could help rebuild trader confidence and pave way for a move towards the 25,800 zone. On the downside, 25,000 will continue to act as key support in case of any further dip. One important thing to discuss is why is the Indian stock market struggling to hit new highs despite strong growth? Low inflation? Or the Nifty scaled its 52-week highs of 26,104 on October 23 on hopes and was set to record fresh peaks within the next few days, supported by stable Q2 earnings and hopes of an India-US trade deal. However, what happened next was quite the opposite of expectations. The domestic market witnessed profit booking across segments. The Nifty is set to extend the losing run to a second consecutive week. We believe the domestic market is torn between tailwinds and headwinds. In-line earnings, cooling down valuations, and India's healthy macro outlook due to lower crude oil prices and a healthy monsoon are key positives for the market. On the other hand, global uncertainties and US tariffs remain key challenges. On the earnings front, the Q2 results of Indian companies have been stable. Aggregate earnings are ahead of our estimates in many stocks. On the macro front, we think inflation could remain low this year and GDP growth may remain resilient despite global turmoil. The RBI, in its last policy meeting on October 1, revised inflation forecast downward to 2.6% for FY26 from the earlier projected 3.1%. On the other hand, the central bank has reined its FY26 GDP growth estimates to 6.8% from the previously projected 6.5%. Valuations too, especially of large caps, have come down to comfortable levels. Nifty is now trading at 21.4 times, marginally above its long period average of 20.8 times, and any evidence of earnings growth pickup should help valuations expand. However, the spoilers are foreign institutional investors, EFEs, who have been relentlessly selling Indian stocks since July this year. Data show they have cumulatively sold Indian equities worth about 1.4 lakh crore in the cash segment since July till November 6. This is the main reason why the market is not able to hold gains. Also, since all global money is flowing into AI theme, lack of any direct play to this theme via domestic stocks is hurting India. Additionally, the persisting uncertainty over an India-US trade deal remains a key overhang. Domestically, the Bihar Assembly elections have added to the cautious sentiment. For FAIs to make a meaningful comeback, the India-US trade deal needs to materialize, which remains uncertain for now. Apart from the trade deal, most domestic parameters including macro indicators and corporate earnings are broadly in line with expectations. If they improve further, it will be a significant boost for market sentiment. Recent GST tax cut measures by the government will also help to reset the trajectory of corporate earnings as more domestic reforms are expected to continue. While any resolution of the tariff issue will be a key external catalyst, going into next week, we expect the sideways market to continue with price action limited to a very small set of companies that declare results. This recent phase reflects a cautious stance among market participants. At Vaya, we believe the Indian markets are in a healthy state versus last year, and the platform is set for Indian equities to mean revert and post an uptick going forward, however long be the consolidation. We expect equity markets to give double-digit returns over the next 12-month period. Valuations too remain reasonable. One should continue to add good stocks on dips. This correction is a buying opportunity as macros are more healthy and earnings are better too. Slow and steady good returns will be made. That's all for today. Wishing you a profitable trading week ahead.